We really haven't been affected by the pandemic. Our investment committee has continued to meet regularly the way we always have. Our business continuity process has worked flawlessly during this period of time. Most people for a while were working remotely, and all of our investment committee meetings were taking place via video conference. But what's very important is that the diligence of research has continued apace. Our ability to both identify and do very thorough research on new companies and existing companies has continued to be completely unhampered by the shutdowns that took place. Our ability to communicate with businesses has continued the way that it always has. And what we've been able to do during this period of time is identify even more new ideas to be brought to our qualified company list than we did during the same period a year ago. No, our approach has not changed. Our process continues to be the identification of businesses that have a high degree of predictability, a high degree of sustainability, above average rates of growth with lower variability, and a high degree of quality. That has remained the same. What we have done is we have incorporated the potential impact that COVID-19 would have on the fundamentals of the businesses early in the process. In other words, in early March, as we saw what China had done as it relates to their economy with their shutdown, we factored into our estimates a 3-month shutdown that would take place on a global basis and see what the impact would be for portfolio companies and companies on our qualified company list. We then reflected that in our earnings and cash flow expectations, and that enabled us to maintain conviction in these businesses, and very importantly, to then be able to translate that conviction into taking advantage of opportunities when the volatility hit during the month of March, which set us very well for the recovery that took place in April. And so the portfolio was able to outperform in the second quarter as it did in the first quarter. Our investment process loves volatility. Historically, this approach has enabled our clients to benefit from significant excess returns during periods of volatility. And there really are two reasons for that. The first is that the fundamentals of the companies that our process identifies and that we invest in on behalf of our clients tends to hold up much better than the average company during periods of volatility. In other words, you can think of them as having low fundamental volatility. And that enables them to obviously do quite well when other companies are seeing their stock prices get compressed because they may be more vulnerable to what's happening in the environment. And the second really has to do with our longer term investment approach. Because we look further than most managers, every investment decision that we make is on a 3 to 5 year basis. During periods of volatility, we're able to take advantage of the mispricing that takes place because many investors are shorter term focused. And we can leverage our conviction through the prism of our longer time horizon and take advantage of those opportunities. The answer is yes. We have added some companies to the portfolio during the months of March and April, during the time where there was a fair amount of volatility, taking advantage of some of the mispricing that we saw in the market and leveraging our time horizon to take advantage of those opportunities. We added companies like Nike to the portfolio, the global leader in sports merchandise, particularly in athletic shoes. And we also added fast retailing to the portfolio. Now, what's interesting is that during periods of volatility, you will see our turnover increase, and that was the case over the last few months. And typically in periods of lower levels of volatility, you'll see our turnover be a little bit lower. And so we did add to take advantage of those businesses. We also added Linde later in the second quarter. Linde is one of the largest industrial gas companies, and as a result of the merger between Linde, the German industrial gas business, and the US business Praxair, and we felt that that business stood to benefit from some of the trends that we were seeing develop over the course of the next few years. So we didn't sell companies directly as a result of the crisis. The companies that were in the portfolio did hold up quite well and outperformed during the period. But what we did find is that some of the companies that we actually added over the course of the second quarter had pretty significant rebounds as the realization that economies around the world were going to start to reopen, that those benefits, which had perhaps seen an impact over a very short term, would actually be beneficiaries over the long term of obviously a rebound in economic activity. So Nike, which we had added during the weakness, had a very strong rebound and the valuation became less attractive. So once again, guided by our valuation discipline, we sold the company out of the portfolio. We did the same thing late in the second quarter with fast retailing. And what we added to the portfolio were some of the companies that I've discussed before. One of the company that we sold was Heineken. And there we felt that given some of the other opportunities in the market during this period of time, we grew a little bit more concerned that the impact on Heineken would perhaps be a little bit greater, as many of the purchases of the beer products that they sell take place on premise, in other words, in various bars and pubs and restaurants. And during that period of time where either economies were continued to reopen slowly, some of that business may be impacted a little bit longer, and we had better opportunities. It's difficult for us to say exactly how we're going to be reacting going forward. What we can say is that we are going to continue to be guided by the strength of our process, the identification of businesses that meet the characteristics that lead to predictable, sustainable, above average earnings growth and cash flow growth with a lower level of variability, and be guided by valuation to make sure that we don't overpay for those particular cash flow streams. What is certain is that this pandemic has been very difficult to predict over the short term. And when you look at the level of uncertainty that is still out there, it's really guided by a couple of things. One is the virus itself, and there continues to be some very significant areas of the world that are seeing continued increases in the number of infections. And you're also seeing some other geopolitical issues, the increase in tensions between China and the rest of the developed world, particularly the United States. And you also have an election that is coming up in November in the US, which promises to be quite heated and which promises to continue perhaps to maintain a certain level of uncertainty given some of the potential wide differences in economic policies that would be followed depending on who wins the election. Today, the portfolio continues to show very good prospects for a return over the next couple of years. We must say that as a result of the very significant rebound we've seen in the marketplace, the valuation is not as attractive as it was in the month of March. But today we continue to have good valuation opportunities on a number of companies within the portfolio. And we continue to have very strong conviction in both the ability of the businesses to deliver strong top line, bottom line, and cash flow growth over our time horizon of 3 to 5 years. The combination of the good growth prospects, the high quality which leads to lower variability in the fundamentals of the businesses, and the still quite attractive valuation that we have within the portfolio give us a high degree of confidence that the return prospects for the portfolio from here continue to be quite robust. The Alliance Trust portfolio is a concentrated portfolio of our best ideas. In order to get into the portfolio, a company must have the best combination of high quality, good growth prospects, and very attractive valuation. Now, having said that, there are companies that face issues at different parts of their life cycle. One company that currently is facing some issues is Yum Brands. Yum is a dominant fast food retailer on a global basis with very strong brands such as KFC, Taco Bell, and Pizza Hut. But it has experienced some issues in its business over the course of the last 6 months. Pizza Hut in North America, for instance, has come under a fair amount of pressure as on-premise consumption of pizza has been replaced almost entirely by delivery of pizza. And while their business model is adapting to some of these new norms, it has fallen behind other companies like Domino's, for instance. Another issue that they've been facing is one of their largest franchisee has declared bankruptcy. And what we have been focused on is to make sure that there would be no carryover impact to the financials of Yum Brands. Now, the bottom line is that we continue to hold Yum in the portfolio. We continue to feel that over time, their ability to deliver the numbers, albeit in the low teens rates, is going to be unimpaired by the short-term nature of some of the issues that they're dealing with. And the valuation continues to remain quite attractive. Therefore, we continue to hold it in the portfolio.